Welcome back, everyone. Today we are unpacking the absolutely fascinating world of business structures. We're taking a journey from the very limits of running a solo gig all the way through to those complex accounting ledgers that keep partnerships balanced, fair, and, most importantly, profitable. If you've ever wondered how multiple people successfully merge their money, their skills, and their liabilities without, completely tearing each other apart, you are in the exact right place. Okay, let's dive into this.
Here's our roadmap for this explainer. First up, sole trader versus partnership. Then, the partnership agreement. Number 3, sharing profits and losses. 4 is fixed versus fluctuating capital. And finally, 5, the appropriation account. Think of this whole thing as a macro to micro journey. We'll start with the broad legal concepts and then zoom right down into the specific financial ledgers.
So, Section 1, sole trader versus partnership. Now, when you first strike out on your own, starting solo is by far the easiest route. But as we'll see, it definitely has its limits.
Let's look at the trade-offs here. A sole trader is obviously the simplest setup. They actually make up about 60% of all small businesses in the UK. You have total control and hey, you keep all the profits. But there's a catch. You have unlimited personal liability. Plus, raising capital is notoriously difficult because banks often view sole proprietorships as pretty high risk. Now, forming a partnership, that neatly solves the capital problem. You get to pool your resources, combine your diverse skills, the whole shebang. However, it's a double-edged sword. It introduces shared control, divided profits, and that absolutely crucial concept of joint liability, meaning each partner is legally on the hook for the partnership's debts.
And because of that shared risk, you really can't just operate on handshakes and good vibes. Which brings us to Section 2, the partnership agreement.
Listen to this definition for a second. The relationship which subsists between persons carrying on a business in common with a view of profit. That comes straight from the Partnership Act of 1890. Notice how incredibly broad that language is. It's literally so wide-ranging that people can accidentally form a legal partnership without even realizing it. Just by working together to make a buck, boom, you might be in a partnership.
So let me pose a quick hypothetical. Imagine you start a new venture with a friend. You hustle, you bring in all the clients, you do, say, 90% of the actual work, but you never bother to draft a formal written partnership deed. So, what happens when the big money actually starts rolling in?
Well, now what's really interesting about this is the harsh reality of default legal rules. If you don't have a written partnership deed, the law steps in and automatically applies that Partnership Act of 1890. And under these defaults, you get absolutely zero salary for all your hard work, you get no interest on the capital you invested, but wait, the most shocking part? Profits and losses are shared equally, period. That means your lazy partner, who barely did 10% of the work, gets 50% of everything. Yeah, this is exactly why a formal agreement is absolutely essential.
So, how do we actively avoid those nasty defaults? Welcome to Section 3, sharing profits and losses.
There are actually incredibly clever ways to structure who gets what. One highly effective strategy is the Pot A and Pot B model. Instead of just dumping all the profits into one giant pile, the firm divides them into 2 distinct pots at the end of the year. Pot A is shared equally among all partners. That ensures a nice baseline of fairness and team unity. But Pot B, that one is strictly performance-based. It's shared only among the partners who actually hit their specific financial targets. It's brilliant because it perfectly balances equal reward with a really powerful incentive for individual drive. Of course, that is definitely not the only way. You could opt for a pure equal sharing, which is simple and builds immense trust, usually great for close family businesses. Or you could use proportionate sharing, where your profit perfectly mirrors how much capital you originally put in. But for larger, more complex firms, you might see a fixed drawings plus points-based accumulation system. Basically, partners draw a monthly salary-like amount, and then they accumulate points for things like seniority, hitting targets, or taking on specialist roles like managing partner. Come year end, the remaining profits are split based entirely on those points.
Let's move to Section 4, fixed versus fluctuating capital, and see how this all builds together. Once you've decided how to share the profits, you're going to need a robust ledger system to track it all meticulously. In partnership accounting, you generally have 2 main choices for maintaining a partner's capital: fixed or fluctuating. The fluctuating method is super simple. You have one single capital account for each partner. Every single transaction, your initial investment, your salary, your share of the profits, your withdrawals, it all goes into this one single account. And because of that, the balance is constantly fluctuating. Makes sense, right? But
Under the fixed capital method, the firm actually maintains two entirely separate accounts for each partner, a capital account and a current account.
Think of the fixed method using a kind of two buckets analogy. Your first bucket is your capital account. This is your permanent foundation. The money you initially invest goes in here, and it stays constant. It doesn't change unless you make a permanent withdrawal or a major new cash injection. Now, the second bucket is your current account. This is for the daily ebb and flow of the business. All those routine adjustments, interest on drawings, interest on capital, salaries, and your share of the year's profits, they all get dumped into this second bucket. It's a method that offers brilliant transparency because it keeps long-term equity completely separate from short-term distribution. All right, let's zoom all the way into the final micro-level step in Section 5, the appropriation account. We know the rules, we know the accounts, but exactly how is the money legally distributed at the very end of the year?
Well, it happens through the appropriation account. By definition, this is an extra section of the final accounts that is entirely unique to partnerships. See, while a sole trader just takes the net profit from their profit and loss account and calls it a day, a partnership uses this appropriation account as the crucial bridge. It's the bridge between the firm's total net profit and the partner's actual individual pockets.
And this brilliantly illustrates the strict chronological flow of the money. Step 1, you determine the net profit from the business operations. But hold on, you don't just divide that number up right away. Step 2 is where the magic of your partnership agreement actually kicks in. You apply the adjustments. You debit the interest on drawings, you credit the interest on capital, and you allocate those agreed-upon partner salaries. Literally only after all those specific financial adjustments are made do you reach Step 3, distributing the final remaining profit into each partner's capital or current account, depending on whether you're using that fixed or fluctuating method we just talked about.
So, the absolutely crucial takeaway here is that a partnership is so much more than just a shared business idea. It is a highly intricate architecture of legal agreements and very precise accounting ledgers, which leaves us with this final thought. If you formed a partnership today, and you did 90% of the heavy lifting, would your legal agreements and financial ledgers accurately reward your true value, or would you fall victim to the default rules? I hope this explainer has given you the structural knowledge to ensure your business partnerships are built on a rock-solid, completely equitable foundation. Thanks for joining me, and keep learning.